Hello, welcome to another episode of Be the Boss of Your Money. This is a live stream. We're going to cover small cap stocks. Small cap stocks have been on quite a tear lately. Lately, of the major averages that I follow between the Dow, the S&P, the Nasdaq Composite, and the Russell 2000, the Russell 2000 lately has been climbing a lot. So we need to take a look at small cap stocks. What are they? Are they worthwhile investing in? And is it something that you should consider? There are a number of ways to go about investing in small cap stocks. I like to take a look at ETFs, and there are tons of them. So let's roll the introduction. We've got a couple of things to talk about. So here goes. Okay, thank you for joining me. If we haven't met yet, my name is Mitch Goldberg. I am a financial advisor with over 30 years of experience. I own and operate a firm called Client First Strategy because I wanted to create a firm truly the gold standard that puts its clients first. Thank you very much for joining me. I would welcome your questions in the comments during the live stream. And if you're watching this in the replay, welcome to you as well. I would love to answer your questions as well, and I will be checking for those. Now, anyone who follows me, who is a viewer of the show, you know that I like to do a quick perspective summary. In other words, not just a summary of what happened in the stock market, but a perspective of what happened in the stock market. So let's just take a quick look, and we're going to do a screen share, and we're going to fly right through this, but you're going to be a better investor for it. By the way, the name of this live stream is called Be the Boss of Your Money, because I want you to be the boss of your money, not your money to be the boss of you. Let's go on. Okay, so first let's take a look at the major averages. You see the Dow had been up over 200 points earlier today. It started last night with an uptick in the futures, continuing into the open. But as the day wore on, expectations grew that Trump would make a speech about China. The speech is going on right now, and it would just basically be has to do with Hong Kong, China cracking down on the freedoms, the business and personal freedoms in Hong Kong. And that has been causing another geopolitical rift between the United States and China, rightfully so. So now we could expect perhaps some sanctions slapped on China, which doesn't come at a particularly good time for the global economy. But I'm giving you the reason why the major averages gave up gains, all that had basically been held on to until early afternoon. The S&P, by the way, these are not massive sell-offs, just the Dow is down 95 points on the day, not a big swing. S&P off only 6 points. Nasdaq off less than 0.5%. But the real killer was the Russell 2000 down 2.5%. This episode is going to focus on small cap stocks. The Russell 2000 that you see there, Russ 2K, that is the benchmark for small cap stocks. Well, like the name implies, it's 2,000 small cap stocks. There's actually 2,003 stocks in the Russell 2000, but it's the small 2,000 publicly traded companies. And now here's something that kind of gave it away. The VIX, as you can see, was up today. And you would expect the VIX to be up on a down day for stocks. They move in opposite directions. But VIX is also called the fear gauge. It indicates that professional money managers, traders are starting to worry a little bit. They're putting on some protection or reducing stock holdings. So the VIX was up today. And I said today in a post in LinkedIn today, I sent this out this morning. And basically I wrote that I wrote, interesting that the Dow Jones Industrial Average, S&P 500, NASDAQ Comp, and Russell 2000 are all up on the day at this moment. But the VIX is also up when you'd expect it to be down. In other words, the VIX should have been down less fear when the major averages were up. So that could be a sign that this rally is getting a little tired. Could be nothing. It bears watching. So that is something, and I wrote bear, B-E-A-R as opposed to B-A-R-E, just a little play on words there. But it means that traders are getting a little protective of their recent gains. We've had some huge gains. We had a 500 point plus day yesterday, 500 plus point yesterday, and the day before on the Dow Jones. We've had a really big rally since the March 23rd low. The rally has come around on expectations that the economy would reopen. The reopening would go somewhat smoothly. It would happen quicker than people expect, and on some potential vaccinations for COVID-19. And we also had a drug called remdesivir, antiviral drug, with positive results as well in treating patients with COVID-19. So we've had the good news, and it looks like right now it's baked into the cake. To me, it looks like a slowdown in the rally. That's how I feel about it now. It looks like the rally has just kind of screeched to a halt. And that's why you saw the VIX. I don't know if you could tell, the VIX was going up. Okay. The VIX was up all day. It should have been down when the other four averages were up, but it was up, and it was basically telling you that the rally was getting a little tired. So let's move on. Let's take a look at some of the market movers, some, stocks you would expect to be up or up today. Dollar Tree, Alexion Pharmaceutical, Regeneron, your COVID-19 plays. But let's take a look at the decliners. The Gap. The Gap yesterday had a huge day up. It had a pretty big down day today. Tapestry, which owns brands like Coach, was down 9%. Norwegian Cruise down 8%. Nordstrom, Carnival. A lot of the stocks that had big gains yesterday are the ones that led the market down today. And we'll go on, and let's just take a look at one of the most important indicators that I look at. That I look at every day. If you want to get a quick indication of what's happening with the stock market, what investors are thinking about the market, and what's coming up in the economy, you take a look at these 11 sectors. I look at the exchange-traded funds that cover the 11 major sectors of the economy, and you see the winners today were utilities and healthcare. Generally speaking, that, we were looking at V-shaped days. Every day has a different shape. Yesterday we're thinking V-shaped economy, V-shaped recovery. Today it's more like a U-shape, because you're seeing stocks that typically, whose earnings and revenues hold up in a recession, doing well today, as opposed to the bottom performers, which you see toward the bottom are industrials, XLI, XLF. You want these to be leading, not lagging. When they're lagging, that means investors are starting to worry that either stocks have come too far too quickly, or that the cyclical type stocks, smokestacks, industrial type machinery companies, they've done well, and now they're giving a little bit back. So people are thinking, maybe, you know what, it's been a little too much, too fast with those stocks as well, and it questions the V-shaped recovery. Okay, I want to show you now the get into small cap versus large cap. You see the green here, this chart. This is going back a long time ago to 1992, which, by the way, is the year that my wife and I got married. And small caps since then are up almost 800%. Large caps, as measured by the S&P 500, are up almost 600%. So you could see over the very long term, small caps have done well. But when you narrow the time horizon, you see that small caps have lagged, and large caps have done a lot better. So the bottom line is that large cap stocks of the last 5 years, 10 years, certainly year to date, large caps have been the leaders. And it's been going on so long that it makes you wonder, should you even bother investing in small cap stocks? So, diversification is a strategy that is used to reduce risk, as you know. It doesn't necessarily protect your overall portfolio from going down in a generally down market, but it's supposed to help it go down less, reduce risk. You don't have all your eggs in one basket. So that's what the good thing is. But diversification is not a strategy that's supposed to help you maximize gains. It's completely different. Than it helps you minimize risk to an extent. But small cap stocks, diversifying into small cap stocks, you could look at, relatively long period of time, 10 years, and say diversification is one thing, but throwing money into something that continuously goes down, that's not good diversification. That is diversification that is El Stinko. We don't want to do that. So that's what we have to decide right now. Are small caps ready to turn around? Are they still worth owning? And we need to just look at the characteristics of those. I want to give you the information that you need to take a look at. So we'll stop sharing the screen for a moment, and we'll take a look at some of the benefits. Small cap stocks typically have the potential to show greater growth rates because small companies just haven't hit that law of large numbers, so they can have quicker growth rates when they're smaller companies. Another thing is when you have small cap stocks, it helps with diversification because you're not creating overlap with your different exchange traded funds or mutual funds. So if you have a lot of, I think most people are heavily invested into the large cap, stocks, top stocks in the S&P 500, if not that particular index itself through exchange traded funds and mutual funds. And you can't invest directly into an index, but you could invest in a security that tracks or mimics an index. So when you have small cap stocks, you're getting different stocks than what are in the S&P 500. So by doing that, you're diversifying, because if you buy a large cap value fund and a large cap growth fund and an S&P 500 fund, you're getting a lot of overlap. You're just buying the same stocks over and over. You might as well just stick with the S&P 500 fund, the index. So anyway, so diversification and higher potential growth rates are the reasons why you would invest in small cap stocks. It hasn't worked out for a long time, but it doesn't mean it can't work out going forward. I'm a big believer in diversification. Yesterday, I spoke at length about diversifying with international stocks, stocks of companies that are domiciled outside of the United States, international investing. I still believe in that for diversification's sake, even though it has not been a great place to diversify. So if you are an investor with mostly domestic U.S. stocks, and you have some international diversification and some small cap diversification, there's a good chance you're not doing as well as you thought you would have. But that's just because you dedicated some of your assets to investments that aren't doing as well. I know it sounds crazy at the moment, but I would continue to be diversified because you never know when things flip and all of a sudden international and small cap stocks start doing better than large cap stocks. Now, we've got a number of companies like Microsoft and Amazon that are trillion-dollar plus companies. And the crazy thing is, as these companies get older, it's almost like they age in reverse. So they haven't really been hit with the law of large numbers. However, that does eventually happen, or it is expected that it would eventually happen. So the negatives to small cap stocks is, even though over the long term they could do better, they come with a lot more volatility. That's one thing. They're also, because they're smaller, less developed in many cases, but smaller companies don't generally have the access to financing and financial markets that their large cap brethren have. So when you go into a recession, small cap stocks have less financial means, and it means that they could do worse or have higher rates of business failures than large cap stocks. I mean, if you think about it, even Macy's was recently able to issue bonds, and you'd wonder why they're doing so poorly. But a lot of small cap retailers, typically they just fold because they lose their access to capital in a recession. So that's one of the biggest risks. I've got a couple of things to talk to you about besides that, but generally speaking, in a recession, large cap stocks hold up better than small cap stocks. So there are a number of ways to look at small cap stocks, but typically market cap of a company, that's why we say small cap, large cap. The cap is an abbreviation for capitalization. So market capitalization is you take the price of a stock, you multiply it by the number of shares, and that figure you get is the market capitalization of a company. So market capitalizations for small companies, small caps, are typically around $300 million to about $2 billion. And then mid caps go from about $2 billion to about $10 billion. And then large caps are considered large, $10 billion and above. Some people consider mid cap $20 billion also. So there's no perfect definition, but when it comes to benchmarks, you do have to stay within a defined range. The Russell 2000, like I said, has about 2,000 stocks. There's another small cap benchmark, the S&P 600. Like you've heard of the S&P 500, large cap, but the S&P 600 is small cap, and that has about 600 companies. The average company in the Russell 2000 index is a little bit bigger than the it's about 1.9 billion on average versus about 1.6 billion on average for the S&P 600 small cap benchmark. So just some things that you should know. So typically small cap stocks are going to be anywhere from 5 to 15% of a portfolio. Most portfolios that I design and that I see, if they have small cap, they'll typically be a 5 to 10% weighting in small cap stocks. Just want you to know. And typically large cap stocks could be 40 to 60, even as high as 70% of a portfolio. And that's not including mixing things up with bonds and cash and mid cap and international. But we're talking about small caps. And when I want to learn more about small cap stocks, one of my resources, and you can go here too, is ETF.com. And ETF.com lists 129. I'm going to do my share screen again. And we could just knock off a couple of screens here. I have a lot of screens open at the same time. Let's get back to share screen. ETF.com lists 129 small cap ETFs. So when I get into ETFs like small cap, I like to just stick with plain vanilla, either a Russell 2000 or S&P 600 tracking ETF. But one of the biggest ones is from iShares, and iShares has a great lineup of exchange-traded funds. It's also the largest. It's one of the oldest companies in the ETF business, and it has the biggest lineup of funds. But their trailing 3 months in the Russell 2000 is down 22%, and then you've got the iShares core S&P core small cap down about 26%. So the Russell 2000 has actually outperformed the S&P 600. That's what the S&P, the iShares core S&P small cap is based on. But then you take a look at the performance of some of them, like the ProShares Ultra Short Small Cap is up 20%. I don't recommend this. This is a leverage ETF, and it's not really something I would look at, but more of a plain vanilla. Take a look at, for example, the I'm looking for a plain vanilla non-country specific one, but small cap growth, iShares Morningstar small cap growth down 11%, and you've got some that are down 13%, some that are up 20%. It's not just a matter of buying a small cap ETF. It's a matter of taking a look at the right one that's right for you. There are ETFs based on specific countries, like Brazil, for example, Japan, for example, and then there are global ones, and there are ones that are just focused on U.S. companies. So that's really the wrap up on how I look at small cap investing. We'll talk more about mid cap and large cap, but I think small cap is more or less the mystery. Got a comment out there. Just want to see there. Hey, John, what's doing? It's great that you really know your stuff. Just saying, hey, you could say that as often as you'd like. By the way, John, I watched you today live on the was it the Long Island Facebook page. For those of you who, and people in my circle know who John Robertson is. He owns a business called The Sexy Salad, and it's a pretty substantial catering and eatery type of business. And John gave us a display of how he makes clam chowder. And John is a foodie, so that's right up his alley. And he talked about his business and how they survived the pandemic. John was also a guest of mine on this live stream, I guess about 3 weeks ago, right, John? Was it 4 weeks ago? And you were a terrific guest. You spoke about how you keep your business surviving. So that's about it for the small cap stocks. I would like to thank all of you for watching. If you have any questions, let me know in the comments. And I'm going to now end this broadcast. Thank you.